Okay, thank you, Nick. Anthony, let's come to you. And obviously, we don't want to get political, but and how you've touched on it a little bit, I think. But how does the Biden administration new budget impact your ETFs?
Yeah, well, I think the good news is that they've agreed to spend a fair bunch of money. We talked about on electric vehicles in particular. That's a huge infrastructure seismic change, really, in the federal government to go and spend close to 500 billion to really upscale electric vehicle infrastructure. That's very, very positive for the entire future car industry. Also, the fact that they basically agreed to now, because of the scares with all the hack attacks recently, to actually federalize basically a lot of spending on cybersecurity. So there are government contracts going out right as we speak across the board for upgrading cybersecurity, from the Pentagon to the State Department to the agricultural area as well. So we're actually very positive that, and we're hopeful that the $3 trillion will be reached and approved in the next 2 weeks. This is one of the reasons I'm here, just to make sure that we fully understand the implications. The other thing is on gene sequencing and cloud. The Democrats are very much in favor of uplifting the poorer hospitals. It's one thing if you're in Beverly Hills at a hospital where you get DNA sequenced for $400 and you get more customized medicine, which is the future. You just don't get it across most of the United States. We have a really unequal healthcare system where until you're 65, you don't really get national healthcare. So they are ready. Just quickly on cloud, just touch on it. The big news is that there's a massive amount of money that hospitals are now going to be able to spend upgrading their cloud and their telemedicine and wearables infrastructure, partly due to the government. I will just say one thing, that our cloud and even our tech megatrend ETFs are not dominated by America. The cloud one is about 70%, but the megatrend one is only about 55% American based. So we are very much global in our benchmarking. And just one last thing quickly is that of all the IT spending certainly in the US at the moment, 50% of it is predicted to be on the cloud in particular. So cloud is still in its early stages. And a lot of experts believe that it's around a 35% spend currently. It's going to go up to about 50%. This is per year in terms of overall IT expenditure. And one other very interesting thing that Nick talked about is SaaS. That's the apps or the software as a service area within cloud. That's probably close to 55% of all cloud spending within the cloud space. So the whole point is that hardware, the old style mainframes or people having servers on site, it's disappearing. And it's being embraced increasingly by cloud technology. And also what's being thrown in very quickly, Simon, is the insurance policy essentially of having cybersecurity as part of your services on a monthly basis, whether it's Amazon or Google or it's Microsoft. Many bankers and others are saying we're not in the area of hiring thousands of software engineers anymore. We really want to rely on the big plumbers and the big infrastructure. So we believe it's positive, and we're grateful that the Democratic Party is actually trying to push through the $3 trillion budget. We believe it will go through. There are just 2 senators here that are holding out, so very close indeed.
Okay, good. All right. Well, Anthony,
I could just add a couple of points there, jump in on the cloud kind of discussion here. So the first that I want to mention is just the nature of the revenue. So if I talked at length at a lot of these software companies, and if you think about the cost of goods sold for all these individual software companies, it has to be hosted somewhere. So as the software industry as a whole really expands and really starts to capture a much larger total addressable market, every cost line item for a software company is a revenue line item for the big cloud guys. So this is going to be a massive business. But the way that I like to look at it too is you have to dissect it a little bit, because if you look at Amazon, like obviously the 3 biggest cloud providers are Amazon, AWS, Microsoft's Azure, and Google's GCP. But if you look at Google, 99% of their revenue is search, right? AWS, if you look at Amazon, most of the revenue is product based, right? And then you look at Google, Amazon, and then the other one, Microsoft. So Microsoft, a lot of their revenue is on the Office 365 product. But what's happening now is a lot more companies are coming out that are focusing on the plumbing of these companies. So that's the MongoDBs, the Datadogs, the Snowflakes of the world. So what we're starting to be able to do, and this is a relatively recently phenomena, is invest in the cloud plumbing directly with these individual companies that aren't part of this overall umbrella of the big 3. So really interesting companies coming, and I think a lot of the ETFs have to screen to be able to identify these and pick these up.
Hey, Nick, I really like that, because what we try to focus on thematic purity as much as possible for when we build our indices relative to our investment themes. So we have like a 1 through 5 category. We look for either, revenue or operating profit exposure, or sometimes something else. But I agree with you. Those companies you rattled off, Amazon, Google, and the like. Yeah, I mean, those businesses are important, but they're not going to be the preponderant driver of their business or their stock price.
For sure. Yeah.
Guys, can I just say that although the revenues for Amazon Cloud might look relatively small, and my wife and many of your spouses perhaps are driving up the revenues for Mr. Bezos, the truth is Bezos is making almost 60% of his profits from AWS. So
no, that's true. That fluctuates quarter to quarter depending on what we're seeing in online shopping. So like this fourth quarter that we're in will be less than that. But I do agree with you that it is a powerful business for Amazon, and it's really one of the secret weapons as to why they're able to do what they do so well and invest in various businesses, because they have that powerful business behind it. No question.
Yeah,
it's just not 100% of their business. That's all.
Right.
Yeah, and I think there are some inherent conflicts of interest built in there, just because how they're kind of sorting their data and how it's powering their decisioning on their product marketplace. So it's going to be really interesting to see kind of how this figures out, and it really does lend itself to a lot of these regulatory concerns, because we saw these Chinese crackdowns, which were huge. They're charging some of these tech companies hundreds of millions of dollars, up into the billions for some of them, just from an anti-monopoly. Okay, you have to pay the CCP. So it's interesting in terms of what's going to come down the pipe for the US in terms of regulation. But while we're on kind of the AWS, if you have a breakup, I think my theory is that anything big enough and powerful enough, the government will come in and find a way to mess it up, right? That's just economics and government 101. So with just how big and powerful Amazon is right now, I don't think that's the end of the world if it gets broken up. Because if you strip out that AWS component, you have so many investors that are really hungry for that growth appetite and the direct exposure to cloud that it'll be put in to a lot of these ETFs, which really increases the capital flow. So I don't think a breakup for Amazon is the end of the world. And if you look at who took over Bezos' seat, right? It's Andrew Jassy, right? And Jassy was one of the guys in the early stage, and it was a side project. I think he was running like the Kindle or something earlier on, but it was a side project at the beginning, and it was just sort of this small revenue line that Andrew Jassy specifically headed up. And there's a reason why he's the CEO now, because they want to concentrate a lot more on it. So yeah, really, really interesting. A lot of movement.
Guys, don't worry about the breakup. It's not happening. The antitrust is not breaking it up here across the street. I will just say, Mr. Rockefeller, even when his Standard Oil was broken up, he became even wealthier. So sometimes when you break up Mobil and Exxon, like it happened 100 years ago with Rockefeller, the guy benefited even more than you'd imagine. Can I just touch on one last thing? Don't forget about the revolution between big tech and healthcare. It's happening fast. The Canadians, where Nick is, are luckier. Where Simon is, you have the NHS, who are actually pretty advanced with QR codes, etc. We don't have it here in the States. But there are companies like robotic surgery companies, Intuitive Surgical, there's Illumina. There are lots of wonderful names that I could throw out and tell you it's early days yet. I mean, the robotic surgery name I mentioned, Intuitive, are now financing these expensive robotic surgery things across the globe. They used to cost $1.5 million to buy, and only Beverly Hills and other expensive hospitals could really afford it. That's being financed on higher purchase now, so it's being broadened, and the recovery rates are about 3 times faster because the incisions are much, much smaller on the patient. So there's just a lot of exciting things. I'm hoping that our kids will have far better healthcare, and it'll be a real customized revolution in healthcare over the next 10 to 15 years.
Here's hoping. Well, unfortunately, we are almost out of time. So just very briefly, final messages. Chris, what would you like to leave the audience with?
I would just say, again, everything that has been discussed on this is extremely bullish over the long term for digital infrastructure. And it's, in my opinion, if you believe in anything that we've said, or even some of the other funds like iBuy that's over on the Han platform, then you've got to be long digital infrastructure, because again, without it, none of it works.
Great. Anthony, very briefly.
Very briefly, it's impossible to time these things. I know the market's come back a little bit over the last 2 weeks. We personally see it as a long-term story. So yes, you may be able to get in a little bit cheaper at the moment, but it's still in the first or second, possibly third innings of the game. So those who think, oh, well, work from home is tapped out, or things are going to go back to normal, I agree with Nick and Chris that we're not going back. The old behaviors are not coming back, because this has been almost a 2-year cycle here. People are now locked in with their current behavior. So we're very positive on the remote working, boosting cyber, boosting cloud. Obviously, the faster the 5G, the more we'll catch up to the Asian market. You really need good infrastructure to power some of these technologies, including telemedicine. So it's critical that the 5G and other tech areas are invested. I'm very excited about electric vehicles in particular, because we're banning now old cars from 2035. Thanks, Simon.
Right. Great, thank you. And Nick?
Yeah, so just a quick wrap up. I'm really big proponent of these software companies. Strong recurring cash flows, really high gross margins, bulletproof balance sheets, and these are business critical operations. So very simple message with our fund is this is a software pure fund. And what we try to do here is, I think value investing used to be buying something worth $1 for 50 cents and hoping that 50 cents goes to $1. But what we're trying to do is, I think value investing is still very much alive, but we're trying to buy stuff that's worth $1 now, but it'll be worth $10 tomorrow, right? So we'll pay the market price. We are cognizant of valuations, but we'll pay the market price, because these will go have very parabolic and nonlinear growth. And dare I say it, the value investing is alive in software. They're very free cash flow generative. Some of them are reasonable multiples. So yeah, very, very bullish on the area.
All right. Well, that's a great place to leave it. So, well, look, thank you very much to Chris, Nick, and Anthony for speaking today. I hope everyone's found it. I'm sure everyone's found it really valuable to hear your views today. For the audience, we do run these webinars regularly, so please sign up for any future events. And if you'd like to hear more about the ETFs you've heard about today or any of the others, go to hanetf.com. Feel free to contact me or your regular Han ETF representative. And thank you very much for listening. We look forward to seeing you again soon. Thank you very much, everyone. Have a good afternoon.
Thanks, Simon. Thanks, everyone.
Thanks, guys.
Thank you.